Okay, so for the second part of Chapter 5, we're going to talk about itemized deductions in the way of taxes. Alright. So this section is called State and Local Taxes. And they list out in the beginning of the chapter personal property. The one caveat to that, because a lot of people get confused, and I mentioned this a little bit in the tax return walkthrough we did, is they have to be ad valorem. So that just means based on value. So that's why the taxes on vehicles in the state of Texas are not deductible, because they're not based on value, they're based on the weight class of the vehicle. So you could drive a Lexus, I could be driving a Honda Civic, but so far as they're in the same weight class, we're both going to pay about $70 a year in registration, etc. So there's that. But if you're in another state, they might base it on value, and then in that case it would be deductible. Something that is based on value are real estate taxes. So Travis County, if you live in Travis County or Williamson County, every year they assess the value of your property, and then based on that value times some tax rates in your district, they assess the tax. So that one is ad valorem. And then for state and local, that's either going to be a general sales tax, which is what we have in Texas, or it's going to be a state income tax, which we do not have in Texas. So normally in Texas, on your return, if Texas is your primary, where your income comes from, where you live, you're going to take the sales tax, because we don't have any income tax. Alright, and then foreign taxes. Most of the time people don't take a deduction for foreign taxes. People take a credit, and we'll talk about that later on. So we probably won't deal with this one in this particular chapter. We'll wait until we get to the credits chapter to talk about foreign taxes. And then any problems you get on a test, or if they give you personal property taxes and they don't tell you otherwise, you can just assume that they're based on value. Now, one thing that's not deductible is a fee. So like to get a fishing license or a hunting license, you're paying a fee. That's not a tax, so that doesn't work. Alright. Alright, so one note about real estate taxes is it talks about jointly owned property. So if you jointly own property with somebody, then between you have to make sure the tax gets paid. So if y'all are jointly liable and one person doesn't pay, that means the other person's liable to pay them. When property is sold during the year, so this is a big one. This I think they have on your tax return assignment, or your homework. Actually, they have this. So real estate accrues ratably throughout the year. It's based on days owned. So you would look at how many days you own the property up to the time of sale if you're the seller, and then the buyer would look at how many days they own the property during the year as the buyer, and you would apportion the taxes that way on the real estate, on the property. Now, one important thing to remember about these taxes is that, okay, before 2018 there was no limit, but beginning in 2018 we have a cap. We have a maximum threshold of $10,000, okay? So any taxes you pay between these three categories, any taxes you pay in excess of 10,000, you don't get any tax benefit for. So before, yeah, you could, but now your maximum benefit is up to 10,000, and most folks will eat that up with property taxes or real estate taxes. Okay. All right. Let's go look at a problem real quick in the textbook. So I'm going to go to the back of the chapter. And I don't want to do the one y'all had for homework, but so if we look at number 35, oh no, wait, that's a multiple choice. I want to do one that's not multiple choice. Okay, I do like number 55, so let's take a look at number 55 real quick. So this illustrates an important point called the tax benefit rule. So if you happen to work in a state that actually has income tax, like California or something like that, and you have a job, well, your employer is required to withhold state income tax from your paycheck, and then they remit it to the state on your behalf, just like the employer does with federal here in Texas. They withhold the stuff from your check and remit it to the federal government. Okay, so California has to do all that same stuff, but on top of that, they have to withhold for the state level as well as the federal level. Now, if they do that, whatever was withheld from your check, you get to take as a deduction. So let's say in 2017, they withheld the $3,600, but then I file the state tax return in 2018. Okay, so this is the deduction I got in 2017. Okay, but then I file my California or other state return in 2018, and I end up with a refund. Okay, so that's what's happening here. It says she had overpaid her state tax by $316. So this is actually going to be treated as income in 2018 because she took a tax benefit for that $316 effectively in 2017. And now if she gets some of it back, well, if she got a deduction 1 year, it's going to become income in another year. Lovely. Number 56, that one is just kind of like a discussion question, but basically it's even though Adam in number 53 says that he'll pay the taxes as an incentive to get the person to buy it, they still got to apportion it as far as claiming the deduction. Okay. Alright, moving right along. So that was relatively short. I think we can move on to the next section without breaking. So let's go back into the chapter. And we'll look at interest expense. Now the main type of interest that's deductible is what you spend on acquisition indebtedness to get your primary residence. So that's interest on acquisition debt. So essentially they mean to acquire or substantially improve the home. Okay, now before 2018, you could borrow up to $1 million. $1 million! Okay, to acquire the home, and any interest you pay on that $1 million, you get to take a deduction for. So if you had a 4% interest rate, well, that would be $40,000 a year that you're getting a deduction for. Okay, I mean, as you pay it down, so the balance hopefully goes down. But then on top of that, you could take out a HELOC, home equity line of credit, HELOC. You could borrow an additional $100,000, and it doesn't matter what you spend that money on. Okay, that extra $100,000 that you took a loan out against your home, you could freaking play Santa Claus with it. You can throw a party, anything you want to do. You could spend it on the house. You could just flush it down the toilet if you want. That would be illegal because it's government property, currency. So you wouldn't want to do that. That'd be illegal. But really, it wouldn't matter what you spent the money on. But after 2018, the threshold has been lowered to $750,000, which is still pretty substantial. So most of the population probably isn't going to buy a home that expensive. So most folks, by acquiring a home, they can get benefit for them. But as far as the HELOC, any HELOC stuff has to be spent on. It has to be spent on improving the primary residence. So you can no longer just throw a party with it like before. So beginning in 18, acquisition indebtedness limited to $750,000, and if you take out a HELOC, then you can't throw a party with it. It has to be substantially to improve the home. All right, that's the main thing. Another thing you can take interest for, interest income, is investment interest. So this was for your primary residence. Now, strangely enough, this threshold applies to a second residence. Okay, like a vacation property, strangely enough. Now, there's a distance test and all kinds of stuff like that to make it qualify as a vacation home, second residence. But the threshold between the two is limited to those to that $1 million, etc., or $750,000 as of 2018. They talk a little bit about mortgage points. Mortgage points is basically like paying interest up front. Normally, you have to amortize mortgage points over the life of the loan. Don't worry about that. But they do say it's deducted over the term of the loan. That means, okay, if the loan's 15 years, then you would divide the points you paid over 15 years, and that's how much you'd get to deduct every year. Okay, we're going to talk about the investment interest. So let's say you invested in a vacant piece of real estate and you were incurring interest to acquire it, then you get a deduction for that investment interest. However, investment interest is limited to investment income. So to get any tax benefit, you have to have investment income from other sources, like a portfolio of bonds and stocks that's paying you income, to get any tax benefit for that. Mortgage insurance premium deduction, go ahead and forget about that. I think that's gone. Alright, cool. So I think we're done with that. I'll go ahead and upload this video.